The idea of owning property as an investment has been deeply ingrained in the British culture. The allure of bricks and mortar has long been seen as almost unbeatable, a tangible asset you can see and touch. But let's face it, with rising taxes, stricter regulations, and those never-ending maintenance costs, property investments might not be the golden goose they once were. Today, we're going to dive into a fascinating case study comparing two investors. One chooses to invest £50,000 in a tax-efficient portfolio, while the other uses the same amount as a deposit on a buy-to-let property. By the end of this video, you'll have a crystal clear understanding of how tax-efficient investments can often yield better returns with a lot less hassle than traditional property investments. Let's kick things off by breaking down what we mean by tax-efficient investments. In the UK, these include options like ISAs, individual savings accounts, pensions, and venture capital schemes such as the enterprise investment schemes, or EIS investments for short. These investment vehicles are designed to help your money grow while keeping the taxman at bay as much as legally possible. On the flip side, property investments often involve purchasing a property to rent out. Sounds straightforward. Well, the rental income you earn is fully taxable, and when you eventually sell the property, you could be looking at a hefty capital gains tax bill on any profit made. And let's not forget the ongoing costs like mortgage payments, maintenance, and management fees that love to chip away at your profits. The key difference between the two boils down to taxation. With tax-efficient investments, you can legally reduce or even eliminate certain taxes, significantly boosting your overall returns. Property investments, however, are subject to a wide array of taxes and costs that can seriously diminish your profit margins. To really bring these concepts to life, let's look at two hypothetical investors, Investor A and Investor B. Investor A decides to put £50,000 into a diversified, tax-efficient portfolio composed of £20,000 in a stocks and shares ISA. Here, all the returns are completely free from capital gains tax and income tax. £20,000 in a self-invested personal pension, or SIP for short. This contribution receives immediate tax relief, and the investments grow tax-free until retirement. And £10,000 in an enterprise investment scheme, or EIS. This offers significant tax reliefs, including 30% income tax relief, exemption from capital gains tax on disposal, and even potential loss relief if things don't go as planned. Investor B, on the other hand, uses the same £50,000 as a deposit on a buy-to-let property worth £200,000. They take out a mortgage for the remaining £150,000. The plan? Rent out the property and enjoy a steady stream of rental income while hoping for the property value to appreciate over time. Now, let's crunch some numbers and see how their investments could perform over a decade. Let's assume the ISA portfolio achieves an average annual return of 7%. Over 10 years, this £20,000 could grow to approximately £39,000. And the best part, because it's tucked away in an ISA, there's absolutely no tax to pay on this growth. This means more money stays in your pocket where it belongs. To put this into perspective, if we look at the Advisor Fund Index, or AFI for short, even investors with a balanced risk profile have enjoyed an average return of 6.57% per year over the past decade, despite recent market ups and downs. So our 7% assumption isn't just wishful thinking. And if Investor A were feeling a bit more adventurous with their investment choices, they could aim for average annual returns of around 8.9% based on historic performance of the AFI Aggressive Index. Cumulatively, that's some serious growth potential. The £20,000 SIP contribution gets an immediate 20% tax relief, bumping the initial investment up to a tidy £25,000. Applying the same 7% annual return over 10 years, this pot could swell to approximately £49,000. When Investor A reaches retirement, 25% of the SIP can be withdrawn tax-free. Not too shabby. And here's a bonus. If Investor A happens to be a higher or additional rate taxpayer, they could snag an extra 20% or 25% tax relief on this investment. We've delved deeper into pension tax relief in another video linked here if you want to explore that further. The £10,000 poured into the EIS grants a juicy 30% income tax relief right off the bat, effectively reducing the net cost to just £7,000. This investment performs well and doubles over the 10-year period, which is entirely possible given the growth potential of the smaller, unlisted companies EIS schemes invest in. It could grow to £20,000. The entire gain would be exempt from capital gains tax. The total projected value for investor A after 10 years is therefore £108,000, excluding potential taxes on the SIPP withdrawals in retirement. Not too bad for a diversified, tax-savvy approach. Now let's turn our attention to investor B's property venture. Assuming an average annual property appreciation rate of 3%, the property's value could increase from £200,000 to approximately £268,000 over 10 years. Sounds promising, but property prices can be a bit of a roller coaster. For instance, according to the Office for National Statistics, the average property increase was just 1.7% in the 12 months leading up to June 23 across the UK. The North East saw a healthier bump of 4.7%, while London actually experienced a 0.6% decrease during the same period. So that 3% growth isn't guaranteed and heavily depends on location and market conditions. Let's say investor B rents out the property for £800 per month, raking in an annual rental income of £9,600. Over 10 years, that's £96,000 in gross rental income. But before we get too excited, remember that rental income is subject to income tax. If investor B is a higher rate taxpayer, they'll owe 40% tax, leaving them with £57,000 after tax. With a mortgage of £150,000 at an interest rate of 3%, investor B faces interest payments of about £4,500 per year, totaling £45,000 over 10 years. That's a significant chunk of change going straight to the bank. Let's be conservative and estimate maintenance, insurance and management fees at 10% of the annual rental income. Over 10 years, that's another £9,600 out the door. Taking the £57,600 post-tax rental income and subtracting the £45,000 in mortgage interest and £9,600 in maintenance costs leaves investor B with just £3,000 over 10 years. That's £300 per year. Not exactly life-changing. When it comes time to sell, investor B will face CGT on the property's appreciation. With a gain of £68,268 sale price minus the £200,000 purchase price, and after deducting the current CGT allowance of £3,000 for the 24 tax year, they'll pay 28% on the remaining gain. That results in a CGT bill of approximately £18,000, another sizable deduction from those profits. Starting with the £268,000 property value, adding the £3,000 net rental income, and subtracting the £18,000 CGT bill, leaves us with £253,000. After paying off the original £150,000 mortgage, investor B's net gain stands at £103,000. Looking at these numbers, both investors have grown their initial £50,000, but tax-efficient investor A edges ahead in terms of returns. Let's delve deeper into some critical factors that could tip the scales even further in favour of tax-efficient investments. Investor A enjoys substantial tax reliefs across the board. The ISA growth is completely tax-free, the SIPP receives an upfront tax boost and grows tax-free until retirement. And the EIS offers generous tax incentives, both upfront and upon exit. Conversely, investor B is hit by multiple layers of taxation: income tax on rental income and capital gains tax upon sale. The taxman certainly takes his share from property investments. All investments carry risk, but property investments can be particularly unpredictable. Property values can fluctuate significantly, and market downturns can severely impact returns. There's also the risk of rental void periods, unexpected maintenance costs, and dealing with troublesome tenants. Tax-efficient investments, however, allow for diversification across various asset classes, spreading and potentially reducing your overall risk. Plus, you're not reliant on a single asset's performance. Investor A's investments offer far greater liquidity. Need access to funds? You can dip into your ISA at any time without penalties. The SIPP is designed for long-term savings, but offers flexible drawdown options upon retirement. The EIS is less liquid, but compensates with substantial tax benefits. In contrast, Investor B's capital is tied up in the property, and selling can be a lengthy and costly process, especially in sluggish markets. Our comparison between Investor A and Investor B sheds light on several compelling advantages of tax-efficient investments over property investments. Here's the rundown. Despite the traditional allure of property, the compounded benefits of tax relief and growth within tax-efficient vehicles often leads to higher net returns over the long haul. More growth, less tax. What's not to love? Owning and managing property is no walk in the park. From finding reliable tenants to handling midnight plumbing emergencies and navigating complex tax rules, it's a hands-on endeavor. Tax-efficient investments like ISAs and pensions are much more hands-off, allowing you to grow your wealth without the day-to-day stress. Tax-efficient investments let you spread your money across various assets, stocks, bonds, funds, ETFs, and more, reducing your exposure to any single market's ups and downs. Property ties up a significant amount of capital in one illiquid asset, limiting your flexibility and increasing concentration risk. The UK government actively encourages investments in ISAs, pensions, and schemes like EIS by offering attractive tax incentives. Taking advantage of these can drastically lower your tax obligations compared to property investments where taxes seem to pop up at every turn. While property has long been seen as a safe and profitable investment, the financial landscape is evolving. Tax-efficient investments present a compelling alternative, offering robust returns, greater flexibility, and fewer headaches. If you're contemplating where to park your hard-earned money, it's definitely worth exploring these tax-efficient avenues that can provide substantial returns without the complexities and risks associated with property investment. We hope this video has given you a fresh perspective on why tax-efficient investments might be a smarter choice than property in today's market. If you found this information helpful, give this video a thumbs up and subscribe to our channel and hit the notification bell so you never miss out on our latest content. Have any questions or topics you'd like us to delve into? Drop us a comment below or get in touch with us directly using the link in the description box. Don't forget to check out the Xenia Learning page, also linked in the description box below. There, you'll find further reading materials and a full transcript of this video for your reference. As always, it's crucial to seek professional financial advice tailored to your specific circumstances before making any investment decisions. Everyone's financial journey is unique, and a pro can help you navigate it wisely. Until next time, plan smart and prosper.